Welcome to Accounting with Madam Mumbi. We are going to be looking at management accounting as a tool for decision making. That is our topic for today. To begin with, we have to think about the decision making process. So the decision making process involves 7 steps. The first one is to identify the objective. So when you're making a decision, you have to identify the objective. For example, if we say the decision is to increase the sales, you have to think about, you have to set that as objective. Then the second step is to search for alternative courses of action. So different mechanisms or alternatives can be approached or can be implemented to increase the sales. For example, you can do massive campaign, that is advertisement and all that. You can also maybe cut down the selling price so that you attract more customers. Could also give discounts that would attract customers. So, and that maybe would increase the whole sales. So you have to search for alternative courses of action that can be adopted to achieve the objective. Then the next step is to gather data on the alternatives. So you gather data on each of the alternatives, and from that data, you select the appropriate course of action, or you select the best course of action. Finally, you implement that decision. For example, if you found advertisement to be the one that is best, you implement the decision, then you compare the actual and planned outcome and respond to divergences. So this is what you call the decision-making process. It is a series of those steps. So in a decision-making, it cannot be made in a vacuum. Decision-making has to be made in a decision-making environment, and there are 4 environments within which a decision can be made. These are certainty environment, where from the word certain, all the issues regarding to the decision are known, and the decision simply involves picking the best alternative. Or you can have a risk environment where a situation may or may not occur, but it can be predicted based on historical data. The probability of occurrence can be predicted. That is a risk situation. Fundamental uncertainty is where the states of nature are not known, neither are their probability distribution. So here, fundamental uncertainty situation, the decision maker, depending on their risk appetite, they make the decision without any information. Finally, you have competition environment, where one decision maker bases their decision on what other competitors are doing. For example, if two firms are in the same industries competing for the same customers, their pricing strategies will be affected by each other, so that when one prices in a certain manner, the other firm may also try to match up so that they can be able to be competitive. The next item we are going to look at is the risk attitudes. And the attitude of a risk taker, the attitude of the decision maker towards the risk is what you are calling here risk attitude. A decision maker can be risk seeking. This is a person who is interested in the best possible outcome, no matter how small the chance of occurrence. So this is a person who takes high risks, anticipating high returns. That is a risk seeking individual or decision maker. You can also have risk neutral. These are concerned with the most likely outcome, so they are indifferent towards risk. And finally, you can also be risk averse. These are people who act on the assumption that the worst possible outcome will occur. Therefore, they take the decision with the least risk possible. That is a decision maker who is risk averse. Now, depending on whether your risk attitude is risk seeking, risk neutral, or risk averse, it is going to affect the kind of decisions that you're going to make. So, today we are going to look at the decision-making criteria under uncertainty. There are 4 of them here. We are going to start with Maximax decision, Maximin, Laplace criteria of rationality, and Minimax Regret criterion. To begin with, we can start with the Maximax decision rule. In this decision, the decision maker looks at the best payoff under each alternative. So he looks at the best income or the best payoff from every alternative, and then chooses the alternative with the best among the best. So this one is coming from the word maximize the maximum. So it's coming from the word maximize the maximum. So maxi is to maximize the maximum. So here a decision maker, we are saying, chooses the payoff, all the maximum payoffs from each alternative. We are going to look at a question where you're going to understand what we mean by this. And then he chooses the maximum of the maximum. So he chooses the best among the best. That is, I should mention that this is for risk takers. People who look at the best possible outcome despite the risk. They use this criteria of Maximax or Maximax. And then the next criteria is going to be Maximin. Here the decision maker looks at the worst possible outcome, that is the minimum, for each alternative, but at least after looking at the worst, he chooses the best among the worst. I'll go over that again. So the criteria is maximize the minimum. So the decision maker looks at the minimum first, that is the worst possible outcome for each alternative. Then he takes the maximum among the minimums. So he takes the best among the worst. That is what you call Maximin decision rule. The next one is the Laplace criteria of rationality. Here, the decision maker, assuming that nothing is known about the probabilities of the various states of nature, it is assumed that all the states of nature are equally likely to occur. They have an equal chance of occurrence. And based on that assumption, assuming that the states of nature are equally likely to occur, we are going to compute the expected monetary value, the EMV, which is a multiplication of the payouts, or payoffs and the probability. Here, assuming that the probabilities are going to be equal in this criteria. The last one is Minimax Regret criteria. So this one, we have to first of all compute the regret. So we are going to be looking at how much, if you make one decision, how much are you going to regret? Or rather, regret is simply the opportunity loss. For example, if you choose an alternative that is going to give you 20,000 in terms of profit, and ignore maybe another alternative that would have given you 24,000, the difference there between 24,000 and 20 is the opportunity loss. And this is what you are going to be regretting. So the regret here is simply the opportunity loss. So we are saying the regret is the opportunity loss, whereby we are going to take the maximum payoff minus the payoff under each alternative, and then we are going to form a regret table. So after getting the regret table, of course, there is no way we would love to maximize regret. That is why this criteria is called minimize the maximum regret. So this one we are going to be minimizing. We are choosing the least among the maximum regrets of every decision. So that is what you are going to do. So to be able to achieve that, we have a question here that we are going to be computing. So the question says that assume that ABC Limited is trying to set the selling price for one of its products, and there are 3 prices under consideration. That is the price of shillings 4, price of shillings 4.3, and price of shillings 4.4. The following information is also provided. These are the alternatives, that is the 3 choices we have. We are either setting the price at shillings 4, either setting the price at shillings 4.3, or setting the price at shillings 4.4. Those are the alternatives. You want to choose among these three things. Now, going back to our decision-making process, we have already identified the objective. The objective is to set a price. Number 2, we already have alternatives. We want to set the price either at shillings 4, shillings 4.3, or shillings 4.4. The third step is to gather data about the alternatives. We have already gathered data on the alternatives. When you talk about data, this is the number of units that can be sold under each alternative. So what we have here, 16,000, is the number of units that can be sold at the best possible condition. So when things are at their best, they can only sell 16,000 at a price of 4 shillings. When things are at the best, they can sell 14,000 units at a price of 4.3. And when things are best, they can sell 12,500 units at a price of 4.4. At the middle, when it's most likely, again, you can sell 14,000 units, 12,500 units, 12,000 units at the most likely situation. And at the worst, you also find here you can sell 10,000, 8,000, and 6,000. Further, you are told that the fixed cost, which we said total fixed cost is constant, is shillings 20,000. And the variable cost per unit is shillings 2. So we are going now to be able, okay, what we are required of us is that advise the company on the best price to set. So we are at the point whereby we want to choose one of the alternatives among these that are given here based on the criteria that we have highlighted. So that is what you are going to do. We are going to, so for us to be able to compute this question, we need first of all to develop something that we call a payoff matrix. A payoff matrix, it is a matrix like this, but now instead of showing the number of units that can be sold, we are going to see how much profit can be earned. So we are going to prepare a table now in form of profits that can be earned. So maybe you can take some time and copy the question, or have a copy of the question so that we can compute it. So we are going to compute the question. To begin with, we want to develop that payoff matrix that I've spoken about, and we are going to get what you have said. Okay, our payoff matrix is going to be in the form, here on this side you're going to have shillings 4, shillings 4.3, and shillings 4.4. Then these are the alternatives. On this side you are going to have the conditions. This is the best possible. And then you're going to have the most likely and the worst possible. So for us to fill in here with the payoff, we have said this one is a payoff matrix. We are going to be computing the profit. So how do we get profit? Profit is equals to total revenue minus total cost. So we can start with the first situation. Looking at our question, we found that at shillings 4, we are able to sell at the best possible, we can sell 16,000 units. So what are we going to say? 16,000 units is what we can sell at a price of shillings 4. And then we get the total revenue. So that is 16,000 times 4. That shall be the total revenue. Total revenue is going to be 16,000 times 4. Then total costs, it is the sum of fixed cost and variable cost. Now, we had been told in our question that fixed cost, this is going to give us 64,000. It's going to give us 64,000, and the total cost is going to be equals to fixed cost plus variable cost. That is how we get total cost. It's the sum of fixed cost and variable cost. In our case, in the first situation, total cost is going to be equals to fixed cost was 20,000 and variable cost was shillings 2 per unit. So you multiply by the number of units. So you're going to find that the total cost is going to be, this is 32 plus 20, it's going to be 52,000. So from this working, we can get that the profit is going to be 64,000 total revenue minus total cost of 52, giving us 12. Giving us 12,000. Giving us 12,000. So that is our revenue at that point of shillings 4. So we are going to fill that here. We are going to fill that here as 12,000. Maybe I can do one more for just explaining the same. So at 4.3 here, the number of units that we had been given that could be sold at shillings 4.3 were 14,000 units. So we are saying we want to get profit, which is total revenue minus total cost. Now this time, the total revenue is going to be equals to, we are saying that at a price of 4.3 shillings, we can be able to sell 14,000 units. So that we get the total revenue. Then the total cost is going to be fixed cost, which we have said is 20,000, plus variable cost, which is now shillings 2 per unit multiplied by 14,000 units. So after getting total revenue and total cost, we are going to get the profit from that. And the profit is going to be, so having gotten the total revenue, it is going to be 60,200 and the total cost is going to be 48,000. The profit is going to be 12,200, which we are going to fill here as 12,200. So using the same procedure, I would go on and on for each one of them, but there's no need. Having understood how you're getting the profit to fill in here, it is simply total revenue minus total cost. Where total revenue is the number of units in units multiplied by the selling price. Then total cost is fixed cost plus variable cost. And variable cost, you had been given variable cost per unit. Therefore, you multiply by the number of units to get the total variable cost, after which you get the profit. So we are going to fill off this table, which we are calling the payoff matrix. So I'm going to fill in the rest of the data so that we can proceed to the methods or to the criteria. So here we are going to have 10,000. Most likely we are going to have 8,000. Here you have 0. Here you have 8750. 8,800. And here you have negative 1,600. And here you also have negative 5,600. Okay, so we had here 8,800 and you have here 5,600 but negative. So that is our payoff matrix. This is one you are going to use when deciding on the price to set using the different criteria that we have discussed. So I'm going to delete the data on this line so that we can use the table now to make the decisions. So now, using the first criteria that we talked about, we said the first criteria is Maximax. So we are going to come here and use the criteria for Max. In this criteria, we said you look at the best possible payoff among each alternatives. Then you select the best among the best. That is the maxi. You maximize the maximum payoff. So looking at this alternative of shillings, setting the price at shillings 4, the maximum payoff that we can get is 12,000. That is between 12,000, 8,000 and 0. The maximum payoff there we can get is 12,000. Looking at the second alternative, setting the price at shillings 4.3, the maximum payoff that we can get there, or the best payoff in that alternative, is 12,200. And in the last one, it is 10,000. These are the maximum payoffs. So we said this criteria is attractive to risk seekers. They choose the best alternative despite the likelihood or the chances that it may occur. So they choose the best alternative in anticipation of high returns. Now in this case, the decision would be set the price at shillings 4.3 because it maximizes the maximum payoff. It is the best among the best. So we are going to set the price at shillings 4.3. So such a decision maker who is a risk taker is going to decide here, decision set at 4.3. So that decision maker is going to say set the price at shillings 4.3 because it maximizes the maximum payoff. Then the next decision maker we are going to have here is the Maximin. Here we look at the worst. That is, we want to maximize but not the best, we want to maximize the worst. So here the decision maker is risk averse. He thinks that the worst will happen. So therefore he looks at the worst possible outcome, chooses the best among the worst. So therefore that is maximizing the minimum. We are going to look at the minimum. The minimum here is 0. The minimum here is negative 1,600. The minimum here is negative 5,600. That is the minimum. So again, as a decision maker who is risk averse, he will choose the best among the worst. In this case, among the 3 which are the worst that could happen, the best is 0. You'd rather not make any profit than make a loss of either 1,600 or 5,600. Therefore, the decision of the risk averse individual is to set the price at shillings 4. So here the decision is to set at shillings 4. That is the decision of the risk averse individual, which will be to set the price at shillings 4. The next decision maker is what we have said, the Laplace criteria of rationality. So Laplace criteria of rationality it assumes that the states of nature have equal chances of occurrence, meaning the best has an equal chance, same as the most likely and same as the worst. So in this case, because there are 3 states of nature, and if each one of them have an equal chance, we are going to assume that their probability of each of them is a third, because they all have an equal chance of occurrence. So we are going to be assuming that their likelihood of occurrence is equal. So what do? We are going to multiply the payoff with the probability, and then we are going to get what you call the expected monetary value. So EMV, in this case, like for this first year, we are going to, not first year, but at shillings 4, we are going to say a third multiplied by 12,000 plus a third multiplied by 8,000 plus 0. Of course, a third times 0 is going to be 0. So this one is going to give us 6,666.7. So that is the first at shillings 3. We are going at shillings 4. We are also going to do at shillings 4.3 a third multiplied by 12,200 plus a third multiplied by 8750 plus a third multiplied by negative 1,600. This is going to give us 6450. Like that. So we are going to do the same even for the last price there, 4.4. And then among those expected monetary values, we are going to choose the best. So we are going to get what we have called EMV. This is what we are going to put here. So we can pick from our working, the EMV here is 6666.7. And the EMV here is going to be 6450. And the EMV for the last column is going to be 4,400. 4,400. So with the three EMVs of 6,666, 6,450 and 4,400, we are going to select the best EMV, that is the best expected monetary value. Therefore, we are going to choose this is the highest. So this decision maker who is risk neutral, who thinks about the most likely situation, who has used probability of assuming all of them have an equal chance of occurrence, is going to set the price at shillings 4 because it gives the highest EMV. So we are going to say here set the price again at shillings 4. That is the decision. The decision is to set the price at shillings 4. So this represents the first three. On the fourth one, we are going to rub part of this so that we can use this table. So for the last criteria, we have to do something. We say that we have to develop what you call a regret table. So we are going to develop a regret table. Here we are looking at minimize the maximum regret. Minimax regret criteria. So we are going to develop a regret table. And we say the regret table is developed by identifying the best payoff under each condition, and then you subtract the other choices and you're able to get what you call the opportunity loss. So in this case, retaining this here as the best possible, most likely, and the worst possible. We can look at it now in a case of shillings 4 here. Among the best possible now, we are reading in the column across, I mean the row, the row across. The best among the best in this case here is 12,200. So if you choose to set the price at shillings 4.3 and you're going to earn 12,200, you're not going to regret anything. So here there will be no regret. But if you choose to set the price at shillings 4 and you're going to miss out on getting the 12,200, you are going to regret 200. That is the difference between 12,200 minus 12,000. You're going to be regretting 200 here. And on this other side, you're going to be regretting if you choose to set the price at 4.4, while yes, the best would have given us 12,200 and you decide to choose to set the price at 4.4, you're going to regret the difference, which is 12,200 minus 10,000. Therefore, you're going to be regretting here 2,200. In the second, in the most likely, here, the highest is the 8,800. If you choose 8,800 by setting the price at 4.4, you're not going to regret. So here the regret is going to be 0. But if you choose to set the price at 4.3, you're going to regret 50, which is the difference between 8,800 minus 8,750. Therefore, you're going to regret 50, which is the opportunity loss. But if you choose the price at 8,000, you're going to regret 800, which is the difference between here 8,800 minus 8,000. The last one, the best is 0. So if you choose this 0, you regret nothing. But if you choose 4.3, you're going to regret 1,600, while here you're going to regret 5,600. So you take the best alternative under each condition, then you less the others to realize the opportunity loss. So now this brings us back to our criteria, which is, our criteria here is that we want to minimize the maximum regret. We want to minimize the maximum regret. Therefore, we are going to first of all get the maximum regret. What is the maximum regret under each alternative? So the maximum regret under the price of shillings 4, the maximum regret is 800. The maximum regret here is 1,600. That is the maximum regret. And the maximum regret here is 5,600. So, when it comes to regretting, we cannot maximize, we minimize. So, when it comes to regretting, we want to minimize the regret. So, we are going to take the least among the regrets. So, the least here being 800. So, you will rather regret 800 than regret 5,600. So, therefore, the decision is to set the price at shillings 4. So, amongst our methods, we can see that most of them agree that we set the price at shillings 4. The only one that did not agree with setting the price at shillings 4 was Maximax Regret criteria, which we said is appealing to risk takers. So otherwise, all the other criteria agree that we should set the price at shillings 4. So that is how you do decision making and uncertainty using those different criteria that we have mentioned. That is the Maximax, Maximin, Laplace criteria of rationality, and Minimax Regret criteria. So if you found this to be useful, kindly like, share and subscribe. Thank you.